We practiced actually same type of question 2-3 times before the break. But when you use constant growth model, which is minus g, the bottom line is you could use this constant growth model when growth rate is constant. When growth rate is constant. That's actually the bottom line, theoretically. Theoretically, that's bottom line. So when growth rate is constant, you can use that model. And your solution actually gives a little bit different actually solution. But as I said, our bottom line is we use that equation, that model, when growth rate is constant. Okay, chapter 8, investment decision. So something familiar, right? This picture, we talked about this the beginning of this semester, the first class. I drew this the diagram before, right? What's the corporate finance? You need to know actually what classification of corporate finance. So I draw at the time this overlapping actually 3 circles, right? The corporate finance is big area like economics or any other academic discipline. So 3 pillars. One is what? The finance, 3 pillars. 3 areas of finance. One is corporate finance, right? Second is investment and financial markets and intermediaries or institutions, right? So we are talking about one of those 3, which is corporate finance. What's the 2 major functions of corporate finance? 2 major decision makings in corporate finance is investment decision and financing decision, right? How to invest money. So once you identify good investment projects, the next step is how to raise money, right? That's financing. What's the investment means? Investing money in a corporation, right? In your corporation. What kind of investment we are talking about? Invest in real assets, right? Such as the fixed assets, right? PPE, properties, plants, equipment, so on and so forth, to produce your merchandise. Real assets. Finance use specific terminology, which is capital budgeting. Capital budgeting is a process. We're going to talk about that. And the other area is financing decision. And the ultimate source of financing is what? Investors, individual households. Ultimate source. Individual investors more than institutional investors. What's the institutional investors? Example.
Goldman Sachs.
Yes, investment bank has actually the department store, but more specifically, 4 major financial intermediaries, such as banks. So when you say bank, commercial banks, and insurance companies, mutual funds, pension funds, and so on and so forth. So we usually talk about 4 examples. That's institutional investors, right? The ultimate source of financing is individual households, individual investors, it's like you. And how they finance money from investors? By issuing financial assets, such as stocks and bonds, right? Stock or bonds. The finance use specific term, capital structure. Simply speaking, debt and equity ratio, capital structure. How much companies gonna issue? stock or bonds. 50-50 or 80-20, 20-80. But this course, the Business 241, focus on capital budgeting. So essence of 241 is actually what? Chapter 8-9, investment decision, capital budgeting. That's the core in 241, how to make investment decision, right? That's the core. What about the previous information, like chapter 2, financial statement analysis, or time value of money? That's actually is the building blocks, basic building blocks of everything. No matter what your major, your area is corporate finance or investment and financial markets and intermediaries, you need to know the chapter 2, financial market or financial statement analysis, or time value of money, or the stock valuation or bond valuation. That's kind of what this kind of information is core. I mean the fundamentals, basics for everything. But as we said, capital budgeting is one of the core corporate finance. And another core is what? Capital structure. Financing decision. That's another major decision makings of corporate finance. So which class? If your major is finance, you're going to study this information in what? 341. The second half of this textbook. So we are talking about actually first half of this corporate finance textbook, right? But if your major is finance, course number 341 covers second half of this textbook, focusing on financing decision, capital structure. Okay. So just review to understand the big picture. What's the capital budgeting? What's the investment decision? Especially capital budgeting is the process, how to choose investment projects. What kind of projects we are talking about? Not only tangible projects, tangible asset, but also intangible. What's the example of tangible? PPE, right? That's the typical example of tangible assets, like properties, plants, and equipment, right? That's the tangible. What about example of intangible assets? If your major is accounting. Goodwill, R&D, how about that? R&D, right? Research and development, right? That's a typical example of intangible projects, R&D. Okay. Remember, we are focused on this. What's the capital budgeting? Capital budgeting is center of the success of the company. How to measure success of your company? What's the goal of your company? Maximize firm value in the market, stock market. More specifically, what? Maximize stock price. But long-run stock price rather than short-run stock price. Short-run stock price also could be manipulated by management, but it's not easy to manipulate long-run stock price. So this is more appropriate term, right? Firm's long-run stock price. So capital budgeting is the primary determinant, not secondary, but primary. More than this, capital structure. Right? So very important, investment decision, capital budgeting, primary determinants of the goal of your business. Okay, how to make investment decision? 4 steps. 4 steps. Now, as we said, capital budgeting is a process, well, 4-step process. Step number 1 is what? Forecast future cash flows. Each one is very important. Forecast future cash flows. Second step is estimate, not given, estimate opportunity cost of capital. Discount rate. How many different kinds of capital you can raise if you have an investment project? Two different kinds of capital. One is what? Debt capital, which is what? Debt capital. By issuing bonds. Right? Your company can raise equity capital by issuing stocks. Yes. Yeah, we're going to talk more about this. And chapter 5, actually, we talked about this, opportunity cost of capital. What's the opportunity cost of capital? Very important. And the third step is, after these two steps, so you're going to make a third step is calculate something familiar, right? Present value of future cash flows. Present value of these future cash flows. Third step with opportunity cost as a discount rate. Right? With opportunity cost of capital, you estimate it as discount rate. And step number 4, use NPV decision rule or NPV decision technique. So look at this title of this chapter, chapter 8, investment decision rules. So we're going to talk about 2-3 different rules for investment decision. So one of the those 3 decision rule is NPV. NPV is, remember, NPV is single most important rule, the most important concept, the most important rule. But we're going to talk about others like IRR later on, and an alternative, IRR or payback period. These two are actually finance theory, based on finance theory, which is the time value of money, discount value or present value. But payback period is not actually finance model, finance technique, because that or time value. Or maybe practitioner or brokers can use the payback period. We're going to briefly talk about that later. NPV is the most important at any circumstance. Bless you. But IRR has a lot of restrictions, pitfalls. I could say the textbook says dangerous. So we're going to talk about that. Why IRR is dangerous. So we focus on that actually in this chapter. The two focus is what? Understand the NPV rules, familiar with NPV rules. And the second goal of this chapter is what? What's the restriction of IRR? What's the pitfalls of IRR? That's another the focus. Okay, before we talk about example, look at the chapters, sections. This chapter 8, this chapter has 6 or 7 subcategories, subsections. 8.1, 8.2. In 8.1 and 8.2, we're going to talk about NPV. NPV rule. First 2 sections, we're going to talk about NPV. I'm going to write down 1, 2, 3, 4, 5, 6, 7. But 7 is just summary, so we can ignore. And the first 2 sections explains NPV, and the section number 3, alternatives, which is IRR, and I actually sometimes I don't talk about payback period, but I can talk because it's not going to take a long time, just 1 minute or 2. Payback period. IRR is very important alternative. And section number 4, choosing between projects, choosing between projects, but important concept from section number 4 is crossover. Crossover rate. This concept is very important. And section number 5, evaluating projects with different lives. Different lives. One project, the life of one project could be 5 years, and the life of another project is 7 years. How could we compare those two? We have a specific, finance has specific technique, how to choose one over the other, right? With different lives, projects with different lives. And the section number 6, we're gonna talk about how to choose projects when resources are limited resources. Our resources are not unlimited, right? Scarce, limited. But before that, we assume resources are unlimited. But we're going to talk about this specific issue in section number 6. Right? But remember, in this class, we're going to focus on this. And you're going to have a final exam based on only those 4 sections. Not 5 or 6, but we're going to talk about this for the My Finance Lab. So My Finance Lab has includes this kind of questions, sections, right? But your final exam based on those first 4 chapters. Okay. Because this is more fundamentals and important, is you can easily understand this. Okay, let's talk about this specific example in the textbook based on this, the procedure. So our investment project, let's pretend you run what kind of company? Fertilizer company. You run a fertilizer company, and you have an investment project, which is what you need to build a new factory to manufacture actually very advanced fertilizer. And the new factory costs $81.6 million. So your initial investment, your investment amount is this, which is this, right? Your investment. You need to make investment, $81.6 million. Once you build this new factory, this project actually produce the following future cash flows for the next 4 years, and $28 million each year. So we can make this kind of timetable, right? Timeline. So once you make the timeline based on this, question, then same as time value of money. Chapter 3, or chapter 5 or 6. Chapter 5 and 6, same thing, right? Again, please draw the timeline. Almost done. I didn't talk about this. First step, forecast the future cash flows. We're not going to talk about that in this chapter. Okay. Next chapter, which is chapter 9, we'll talk about this. How to forecast, how to estimate future cash flows. That's chapter 9. in this chapter, we assume future cash flows are known. We assume, but that's not practical, right? Not realistic. And step number 2, estimate opportunity cost of capital. That topic is actually beyond our 241. That's 341. 341. If you take 341, you're going to talk about this. What's the cost of equity capital? How to calculate cost of debt capital? That's what we're going to talk about. 341. So how many of you are going to take 341 in the future? No? Nobody? No finance major? No. Yeah, I'm gonna teach next fall. 341. Okay. That's business 341. 341. But again, we assume it's the opportunity cost of capital is given. Like cost of capital is 10%, for example, in this chapter. Third step, calculate present value of future cash flows. So we assume we know this value. So this chapter actually focus on these two steps. Okay, this chapter 8, focus on this. These information are given. So we focus on how to use this MPV rule technique. So focus on the math part, which is the simple, straightforward. Right? This one is extremely difficult. This one is extremely difficult. These two, 1 and 2. Garbage in, garbage out. You know what I'm saying, right? If your first 2 steps wrong, third step, fourth step is garbage actually, right? Very difficult. Yeah. So chapter 9 and the different course. So we focus on this. So look at this. If you make investment today, your projects will produce these future cash flows. So the future cash flows are this, right? So we need to calculate what present value of this and discount it at the cost of capital. And then use NPV. What's the NPV? What's the formula for the NPV? What's the formula? What's the formula for profit? The accountants actually make profits. Revenue minus cost equal profit. Same concept, right? Net profit, net present value. So whenever we read net, that means what? Something minus something. That's net profit. Net profit means gross earning minus expenses, deductible deduction. Same thing. Gross present value minus cost, investment. So that's present value of future cash flows minus investment. Okay, how to calculate present value of these future cash flows? Let's say our discount rate is opportunity cost of capital is 10%. Is that right in your textbook example? What's the cost of capital? 10%, right? 10%. 28 million divided by 1 1.1, right? 1 plus 10%. What's the second money? 28. 1.1 to the square. So we could say 1. And then what? Minus your investment is $81.6 million. Yeah, that's the NPV. But as you can see, this is what? What kind of cash flow it is? Single amount? Why single amount? Multiple amounts, right? And what kind of cash flows it is? Type 1, type 2, type 3, type 4. We use that kind of conversation only in this class. First, type 1, type 2, type 3, type 4. What type? 3 or 4? One future value, present value. One, two, three, four.
Can you name what they are?
Four, right? Yeah. Present value of annuity, right? Present value of annuity. Yeah. What's the formula of the present value of annuity? Each payment divided by interest rate, right? And parenthesis 1 minus 1 plus I to the n. Yeah. So you still remember. And minus 81.6 million is already cash, right? I mean the present value, right? 81.6. Oh, plug in 28 million, right? 28 million, and discount rate is 0.1. 0.1. And what's the n? 4. N 10%. 81. So how much is your net cash flow? 7.2 million. Very good. Net present value is $7.2 million. Of course, positive. What does that mean? Look at this. As I said, NPV is the most important, single most important rule, technique, more than other alternatives. What's the key concept of the NPV rule? Look at this. Only NPV rule can tell how much this project can contribute all of your business to the shareholders' wealth. Simply speaking, what stock price, right? More specifically, the larger the NPV, which is the $7.2 million in this case, the larger NPV means what? The more value this project added. What's the added value means? Added value means what? That project can give higher stock price, which is the core of the business, right? Core of the company. Other company cannot tell that information. The single most important thing to NPV. This one is actually first 2 steps. Indicates first 2 steps. First step is what? Estimate expected cash flow. Very important calculation, very important input. And the second one is what? Estimate the cost of capital. Depends on riskiness. The riskiness of cash flow is very important. Two major determinants. Major the input to the calculation of NPV. So these two factors actually what? Directly relate to shareholders' wealth. Maximize shareholders' wealth. These two factors: the estimated cash flow, future cash flows, and the riskiness of these cash flows. Yeah, in this case, opportunity cost of capital is 10%. So we can use that rate as a discount rate. Let's briefly talk more about the opportunity cost. Even if we don't focus on opportunity cost of capital, even if we talk about that in 341, we need to know a very basic concept. As the minimum acceptable rate of return. Minimum acceptable rate of return. Yeah, we are talking about investment project in a corporation, right? Project in a corporation. And if you, as we said, once you as a financial manager identify good investment project, then the second step is to raise money. Raise money from investors. Another word, shareholders, right? Shareholders. And the financial markets and institution actually intermediate. Transfer money from A to B. The concept of opportunity cost of capital is like this. So you as an investor, the shareholder, you may have your own investment opportunities in financial markets. Investment opportunities in the financial markets. If you don't invest actually in this company, you're gonna have actually two different kinds of investment opportunities in financial markets. One is safer assets, safer securities, or risky securities. Two different kinds of securities you can invest in financial markets. What's the example of safer assets, safer securities in financial markets? U.S. government securities, right? Let's say that is 5%. U.S. Treasury notes, right? Let's say, or even bills. Let's say that gives 5%. On the other hand, if you invest in risky assets, then these risky assets actually require, let's say, 10% or 15%. Let's say 15%. How determine the cost of capital is? It depends on the projects. It depends on the projects. Corporation. your project could be risky or safe. Let's say this is U.S. Treasury bill. Actually, U.S. Treasury bill is much lower than this. Let's say just corporate securities. I mean the U.S. Treasury securities. And this is what the required return on stock investment. If your project is safer, you can use the rate of U.S. Treasury securities as your opportunity cost of capital, as a discount rate, so 5%. And if your project is risky, you can use the return on stock market, right, which is 15%. Yeah, that's the concept of opportunity cost of capital. That's the minimum acceptable rate of return. So it depends on the riskiness of your projects. Depends on riskiness of your projects. So if your project is safer, you can use the U.S. Treasury securities return. Rate of return. If your project is risky, you can use return on stock market. The YNPV again. So first, the most important answer is what? NPV can tell us how much this project actually contributes to the shareholders' wealth, right? So it focuses on how much they can build the shareholders' value. Shareholder value, as you said before. And the number two, another important actually reason for why NPV is NPV has less fewest limitation. So NPV rule has the fewer limiting assumptions. But the alternative technique, which is IRR, internal rate of return, has a lot of limiting assumptions. So the next class, we're going to start from this point, actually. We're going to talk about 3 or 4 different pitfalls, the limitations of IRR. And then next time, we're going to use how to use financial calculator. So please bring your financial calculator next time. How to use NPV rule and how to use IRR. So you're going to use the calculator when you take the exam. Otherwise, it's going to take forever. And NPV, you can calculate with a regular calculator, but you cannot solve for IRR without calculator. Impossible. So this concept is same as yield to maturity for the fund valuation. Same concept. Without calculator, you cannot calculate yield to maturity in fund valuation. Is that right? Right? Same thing. And if you use Excel spreadsheet, their function is same. When you solve yield to maturity, you're going to use IRR, the formula. Same function. As I said before, my previous corporate finance class 241, I have one more hour. So 4 credit actually course. We use actually Excel spreadsheet, but not in this class. So you need to practice on your own. But if you have if you work in a company, you're going to use Excel spreadsheet because it's more flexible. Once you are familiar with that, it's very flexible. Let's briefly talk about payback period because I have time. I don't want to actually spend too much time on this. Okay, this example. Start from today. Your cash flow is negative 1,000 at this point. But at the end of the year, your project gives 500 plus 500. Then what's the cumulative cash flow at the end of the first year? At the end of the first year, you can cover actually half. So minus 1,000 plus 500 gives minus 500, right? Your cumulative cash flow is minus 500. You haven't actually to recover your initial investment yet. At the end of the first year. What about second year? After the second year, minus 400. Your project is plus 400. Oh, what's the cumulative cash flow? Minus 100. So not yet. After the second year, right? After the third year, how much is your cumulative cash flows? Plus 200, right? So more than your investment, right? You can make more than your initial investment. Oh, what's the number? The formula is this formula: number of years prior to recovery. So after 3 years, actually, you can recover more than your investment. So number of years prior to full recovery means what? 2 years. So your payback period should be what? In between 2 to 3 years. So after 3 years, you can actually recover more than your investment, right? So your guess is what? In between. After 2 years, but before 3 years, right? Denominator is what? Cash flow during the full recovery period. During the third period, how much cash flow you're gonna have? 300, right? That's 300. Denominator is 300. And the numerator is what? How much is uncovered cost or investment at the start of the year? How much uncovered?
100.
100. So 100. So 1 over 3, right? So final answer is what? 2 plus 1 over 3rd. Yeah, this is actually what? The simple algebra question. 2 plus 1/3 is same as 2 and 1/3 or not?
Yeah.
How many of you guys yes? Not this. So ask your brother. Okay, the same thing, right? 2 and a third year. 2 years and maybe how many months? 1/3. 3 months? 4 months? Yeah.
4 months.
Yeah. 2 years and 4 months. That's it. That's how we're gonna find out payback period. Okay. So next time we're gonna talk about this. The pitfalls of under 3 or 4. And you're gonna have this kind of question. So next class is very important. Maybe I don't know. I'm not quite sure. I can look at my schedule.
So come next Thursday.
I try.